Hey guys, it's MHFin. In today's video, I'll be going over some tips in regards to buying options on Robinhood. Trading options can be incredibly difficult and confusing, and understanding just some of these will ensure you have a chance to make some money. Let's not waste any more time. Let's get started. Rule number 1. Stick to trading high liquidity options. I'll quickly demonstrate why this is so incredibly important by showing you an example comparing the impact of such a move. Let's pretend you're buying calls for Ralph Lauren and Apple. The first thing you want to get familiar with is the bid and ask prices. These will tell you the story right away. The ask price shows how much it would cost you to buy one contract, while the bid price shows how much you would receive if you sold one contract. Now the difference between these two prices is called the bid-ask spread. On low liquidity options like Ralph Lauren, these spreads will be rather large. As you can tell from our example, if we were to purchase just one contract of Ralph Lauren options at $440 and we went to sell it the very next microsecond, we would only receive $380, losing $60 right away, basically 14% of our investment. In essence, we're starting 14% in the hole on everything we buy. On the other hand, Apple, a high liquidity option, has a tight spread. Using the same scenario for Apple, we would only lose $2 or 1%, a massive difference when we look at trading options long term. Options are hard enough. Don't put yourself deeper in the hole when you don't have to. Make sure you're trading options with tight spreads and high volume. Rule number 2, and I can't stress this enough, buy call and put options when implied volatility is low. I learned this the hard way, and by just understanding this concept, you will start to see how much easier it is to profit off some of your options trades. Implied volatility is so incredibly important in options pricing, and buying it when it's low is one of the best ways to increase your profits. Let's run through an example to show you this. Let's say you're buying SPY call options thinking it's going to go up. The current price is $278, and you decide to go with the $282 call expiring March 29th, a month from now. At this point, the implied volatility is 9.89%. To simulate profits, we input our parameters into a tool, something like optionscalculator.com. This tool will output a chart showing what kinds of profits or losses to expect given a moment in time and price. We can see that if SPY goes up to $280 later that day on March 4th, we'd expect a 37.7% profit, which translates to $54. Great. But watch closely as to what happens if implied volatility were to go down to 4.38%. Just changing this one variable, you can see that we would now expect to lose 0.7% of our investment, resulting in a loss of $1. The only thing that changed there was the implied volatility. As you can tell, if we were on the wrong side of it, your profits can take a severe hit, even if the scenario predicted happens. Please make sure you're buying calls and puts when IV is low. Rule number 3, make trades frequently. If we for a moment treat options trading like a roulette spin, we can conceptualize what I mean by this. Let's say you're at the casino and you're trying to make money off gamblers. On the casino side, you have a 52.7% chance of winning on each spin because of the green zero. A 2.7% advantage may not seem like a lot on each spin or 10 spins, but over 1,000, the chances that you make money increase dramatically. Of course, you can have a bad hour when someone gets really lucky on a couple spins, but long term, over thousands of spins, you will make money given you have an edge. Same concept exists with trading. If you think your move has positive expected value, you can ensure over the long term by placing many trades your profits reflects this edge. Additionally, you want to make sure you're buying options with deltas that are realistic. Buying calls, $600 calls for Tesla expiring in a month is stupid. Too many people see the cheap price but never consider the insane amount of luck required to ever profit off options with incredibly low deltas. Make sure you're trading options with deltas in the 0.50 to 0.80 range. Rule number 4, make your bet size appropriate. Too often I see someone I know deposit on Robinhood and proceed to lose their entire account in a week. Use tools like Options Calculator to understand your expected profits and losses. The great thing about options calls and puts is that you'll always understand your max risk, meaning you'll never lose more than what you put in. Please understand this and bet accordingly. Like I mentioned earlier, you want to make sure you can bet as many times over the course of a year, and betting big just won't allow you to do that. Bad luck or one stupid decision shouldn't cost you your entire account. Thank you for watching. Please don't forget to subscribe to my channel, and if you could please leave a comment below. I'd love to hear some feedback from all of you.